All right, good evening, everybody, and welcome to Ivan Oberon's Money Matters. This is Thursday, September 11th, 2014, especially for those of you listening to the podcast. And I want to thank you so much for being here with me. If it wasn't for you guys and for everything that you do and are working to do in the real estate investing world and industry, we wouldn't need these types of things. So thank you so much. And I just want to thank any of our service members who are out there fighting for our freedom. And of course, all of our firefighters, police officers, everybody involved in those service industries. Just as a reminder for this day and what it stands for, what it represents 13 years later. It just so happens we're going to be going over 13 of the insurance myths for real estate investors today. So, like last week's webinar, even though it's we're talking about insurance, we're going to keep it light. We're going to keep it entertaining, and we'll even field some questions and get you guys to participate if that's something that you guys feel up to today. Just raise your hand and I will unmute you and we can have a conversation, whatever it is. But the idea and of course the goal is to educate, to make you guys aware of issues that maybe you're not aware of, to make sure that you're making the right choices when it comes to protecting yourself. And nobody wants to talk or likes to talk about insurance per se, but everybody understands that it's a very important and integral part of your business, and it's something that you need. And you guys might have noticed as of late, I've really been shifting my focus into education in this sense because I really want to add value to my fellow investors. And I've seen a lot of different things happen in this business from the moment that I got started to today that really are quite frightening and make me afraid for my fellow investors out there. And partially is because there's just a lot of misinformation and a lot of people that are showing the wrong things or issuing the wrong types of policies just so they can write the business. And it's just it's not right in my opinion. And so I'm here to set that record straight because I was one of those guys, even though my background is in insurance, and I spent over 10 years in insurance before really going full time into real estate investing. I still had challenges in the beginning, even though I had access to different markets and carriers and et cetera. Finding the right type of coverage, finding the right type of insurance, and kind of navigating through all, what is true, what is false, what are my actual risks and my actual liabilities out there as a real estate investor, because I was brand new in the business, and so I understood things like property insurance and liability and the different things that come up, but I didn't really know and fully understand when I got started everything that I needed. So the very first project that I got into when I got started, I was partnered up with another lady, and some of you may have heard this kind of story before in the past, but what ended up happening is I brought all the money. She had the property under contract, and she was going to manage the rehab and everything for us because she had gotten it under contract right there in her backyard, which was about 3 hours away from where I live. So kind of going through the process and seeing, okay, now that we're closed, where's my insurance certificate, right? So I'm hounding her because I'm in the business and because I didn't really have, I wasn't sure where I was going to go for insurance coverage. I let her kind of handle that from the beginning, just told her, hey, you got to go and you got to get this done. And pretty soon she sent me a certificate of insurance. She was so happy because the premium was like under $700 a year. And she said, yeah, I did a great job. Check out how much money we're going to save on this. And it's super cheap. And when I'm looking at it, it's a homeowner's policy. It's a homeowner's form, basically, that the certificate of insurance was written under. And that was my first kind of wake up call of, I really need to devote some more time searching for different carriers out there. Pretty soon I progressed and I moved on to other carriers that they said they specialized in kind of vacant properties and things of that nature, supposedly properties under renovation. And so I started with them, and they were Foremost and American Modern. So that's where we went with our second and our third property. But there was still something missing. I just had this feeling that this just isn't right. There's a gap, and maybe there isn't just the right type of policy out there for this particular type of business yet. It's not a brand new business, but it was still a very novel kind of emerging business when I got into real estate investing. So I thought, well, maybe there isn't just the right thing just isn't out there. But I kept searching until I finally found what I consider to be the right policy, the right coverage options, and all those right things according to my standards as an insurance agent. And so I went with them and started insuring all my properties from that point on with them. And we're going to talk about who they are, and really just wanted to give you a background of why I'm kind of passionate about educating my fellow real estate investors and actually advocating and promoting for National Real Estate Insurance Group. I also am now the exclusive insurance representative for the American Association of Private Lenders. So for all those of you that are in the business, you're dealing with those private lenders, with those hard money lenders, and without them, our jobs as real estate investors, especially if you're a fix and flip guy, would be much more difficult if we weren't able to leverage the funds that they have available. So by educating them, by being able to provide the right type of coverage at the right time for them, and educating their borrowers so that their collateral and everything is protected, it allows me to really add value to the real estate investing community, and that's what we've done from the beginning. And for me, it's something that now I'm very passionate about, because it's a very tangible thing that I can do with my experience, and that now I'm blessed to be able to be a part of. So that's me. I'm Ivan Oberon, for those of you who don't know me. My email for these purposes is ivan@nreinsurance.com. And this is going to be the 13 insurance myths for real estate investors. So whether you're brand new or you've been in the business for a while, I find that both parties don't necessarily know all the right coverages, and there are a lot of myths that people understand and believe, and just because they've not been educated by the right people. And so hopefully tonight we'll dispel some of those things and get you feeling more confident about where to go for your real estate investing insurance needs. So getting right to it, promised I wouldn't keep you guys for more than an hour. The number one, or not the number one, but number one, is insurance is exclusive of estate, tax, and financial planning. Now, what do I mean by this? Well, a lot of people go into it thinking that if they got the right type of insurance and they carry the high enough liability limits and they insure their properties right, and they get all those things done, that they don't necessarily need to worry about their tax planning, their asset protection planning, etc. So, don't go by the assumption that if you have the right type of insurance, which I'm going to show you what it is, that you're covered in all those other areas. And I know most of you are probably pretty savvy, but believe it or not, there's a lot of people that think that as long as they have the right type of insurance, they don't worry about how they're going to form their entity. Are they going to hold properties in their land trust? Are they going to do them in an LLC or an S corp? They don't go into having the right type of tax strategy, because a tax strategy, when you begin your business and when you're involved in your business, is also separate from entity protection, right? And if you don't have the right type of tax strategy and plan set in place ahead of time, you're not going to keep as much of the money as you would hope to keep doing these projects. So you got to make sure that you're connected with a good CPA, a good tax attorney, and somebody who understands asset protection. And in some cases, there are some firms and people out there that wrap them all into one, just for the sake of convenience for you, and obviously for the sake of business for them, because they vertically integrate all these services that they know that real estate investors need to set themselves up properly. So whether you piece them all together or whether you get them all under one roof, make sure that you have the right type of attorney, CPA, tax planner, in addition to the right insurance consultant for your projects, whether you're flipping houses or investing in cash flow real estate, which obviously that's everyone's goal at some point, investing in notes, apartments, whatever it is. You got to get those things locked in, and insurance, yes, is a very, very critical piece, but you can't rely on just insurance for your overall strategy. All right. And I had some pop-ups here. Well, we're going to keep going. So, yeah, well, to illustrate the point here, and I know it's difficult for you guys listening to the podcast. Doggone it, come on back. You got to consider insurance as kind of the archer in the watchtower. Okay, not necessarily your castle walls. So you're protecting your business items within the castle walls. So the insurance is not the foundation of any asset protection strategy. And just to kind of get through this, insurance is more of the guys that protect things from when things do happen on the inside. So the legal entities that you create are your actual castle walls, the moat, and the watchtower you build to protect those things. And again, the insurance policy is going to act more like the archer in the watchtower once you have those right protection strategies in place. All right. So number 2, being named as an additional insured on the existing homeowner's policy will be sufficient to protect your interests in a subject to or lease option deal. Now, we threw this in here because I know a lot of you are getting into some of the more creative strategies like lease options, subject to, contract for deeds, and those sorts of things. And in many cases, you're taking some kind of ownership percentage by contract in these properties. So what a lot of people are doing is just add me as additional insured, or there's a lot of terms out there: additional insured, first named insured, certificate holder. Various terms out there that get confused easily by people. And so, go ahead and put me as additional insured on the existing homeowner's policy. It will not adequately protect you. So the right way to do that is actually by getting your own tenant policy or dwelling fire policy to protect you against those things, because you are actually, you have the ownership interest. So you need to be the first named insured on an insurance policy, not an additional insured, because when a loss happens, the additional insured people listed on that person, whoever's living in it, their homeowner's policy is not going to, you're not going to be the first payor. They're going to pay the first name insured first. So you want to make sure that you always have your own separate policy, which would be a dwelling policy where you are the first named insured at that location. Now, one of the reasons that people shy away from that sort of thing, or by having their own policy to protect themselves properly, is because they're afraid of the due on sale clause. That's one of the, the big worries and concerns you hear about in the circles when you're talking about, the owner finance circles, contract for deeds, subject to, all those lease options, all those kinds of things. The big dirty term is, well, the due on sale clause. What if it triggers a due on sale clause? Well, that's a valid concern, but I can tell you that I've never seen it happen, and nobody that I work with has ever seen it happen, either on the insurance side or on the real estate side. As long as that mortgage continues to be paid, the banks have no interest in calling their notes due. You know what I mean? They want that mortgage to be on time and continue to be paid without incident. So you go ahead and you get yourself your policy, you add yourself as the first name insured on that policy. So when a loss happens, you can file the proper claim and be indemnified properly. All right, number 3, buying a property in your personal name and using your homeowner's policy liability is fine. Now, most of you probably are shaking your heads and you would never do this. But believe it or not, people do it. And I've heard people recommend this, and it's kind of commonly known that if you have a homeowner's insurance policy, and for example, you're going to have a wedding or a special event, or in some cases, you'll have a secondary residence. And what some people will do, and what a lot of carriers will offer to do, is to extend liability to that location for that specific special event, or to extend liability to that secondary residence, right? Not a rental property, but say you have a vacation home and you use it as your secondary residence, the primary homeowner's insurance policy will extend liability under those circumstances. But in the case where you have a rental property where it's deriving income, that's technically considered a business exposure because you're deriving income from it. Or if you're renovating properties or have vacant properties, those are all excluded under your homeowner's liability policy, and so it will not work. So don't get stuck being misinformed on that particular thing. So it doesn't happen. And you have people slip and falls, of course. It's personal liability. You got these vicious dogs. You got these pretty fluffy dogs on there too. Like, all these different things can create liabilities for you, and those are all personal liabilities that are going to be insured under your personal homeowner's policy. It will not extend coverage to any of your projects or any quote unquote business activity, whether it's a fix and flip or a rental property. And we're going to get into a little bit more of that a little bit later, but that's another big misconception. People don't consider their rental properties as a business activity. They consider them, well, I own them personally, they're for personal income or whatever. And that's not the case. And partially, the insurance companies out there are the ones that are perpetuating this falsehood, because you have your homeowner's policy, and then of course they always want to get you to write your auto insurance policy with the same company because you get a discount, and they're underwriting the same stuff. And then if you have rental properties, they'll go ahead and insure those rental properties as well and start covering everything under an umbrella, right? The problem is that in most cases, if people are doing it right, they're insuring properties, or they're owning those properties in LLCs and trusts and corporations, family trusts, land trusts, all kinds of different entities. And then it starts to become a problem. And ultimately, it is considered a business exposure. So we'll get into that. All right. Myth number 4. The personal dwelling fire policy is sufficient to cover my non-owner occupied rental. So this is exactly what we were talking about. You have carriers that are insuring rental properties under what is considered or called in the industry a dwelling fire policy. It's also known as a DP form. Typically, it's DP1, DP2, DP3, and that just explains the difference between whether it's a basic form, broad form, or special form coverage form that the policy is actually written under. And certainly a dwelling fire policy is the more correct policy to insure your rentals under versus a homeowner's type policy form. But because of the issue that we were just discussing, your rental properties that are generating income for you on a monthly basis are considered a business exposure. And if you look into the tax law, if anything were to go wrong, they could claim that it was a business exposure. They could potentially deny a claim, and you could potentially be subject to a different tax basis because of it. So we don't insure rental properties under a personal dwelling fire type policy. We insure everything on commercial forms, and there are many benefits to that. One of them, of course, being that it's the right type of coverage for that exposure. Other things are personal dwelling fire policies exclude things like pollution. They have a overall pollution exclusion on those policies, and one of the things that can happen, and where many liability claims come from, is carbon monoxide poisoning from some kind of appliance, a water heater. Something that has a flame on there creates a contaminant in the air. The tenant or guest gets sick, and next thing you know, you have a huge liability claim, and those are always excluded under personal dwelling fire policies. So under a commercial policy, you don't have those types of exclusions. You have that coverage available for those basic pollutants, and that's another added benefit to again protect your assets, because your liability claims really are going to be where your biggest risk is. They say that your property claims, yeah, they can bend your financial situation, but it's liability claims that can potentially break your financial situation if you don't have the right type of coverage. All right, number 5. I have a personal umbrella policy, so I don't need commercial insurance. This kind of segues back into number 4. What a lot of people do, and again, it's because the carriers and the agents, the personal lines agents perpetuate this. You have your homeowners, you have your auto insurance, and you start adding your rental properties. And now, well, you increase your net worth, and thus you increase your liability exposure. So now the $500,000 maximum coverage under a personal policy, in most cases, isn't enough, and so you got to start off getting additional umbrella coverage. And an umbrella policy is just an extension of your underlying liability insurance. So, say you have $300,000 or $500,000 on your underlying insurance, covering your homeowners, covering your rentals, covering your auto policy. Now they throw on this additional $1 million umbrella, or in increments of $1 million. You can get up to just about as high as you want to get, depending on your net worth. So now you're covering everything under personal policies. The problem is, when you have this commercial exposure, you can't use a personal lines insurance policy to cover a commercial exposure. So anything that's and I'm referring to a quote unquote business exposure, like we were talking about the rentals, anything that generates income for you is technically considered a business exposure, and they're all personal lines policies have exclusions for business type exposures. Now, it says on their umbrellas are not a panacea, so it basically means that one doesn't cover all. It doesn't encompass all. There's specific reasons why you use specific types of insurance for different needs, and why you want to separate your personal liabilities from your business type liabilities at all times. Now, how much is enough? Well, one thing that I learned from a risk control person early on in my career was you want to make the insurance coverage or the insurance policy more attractive than your actual net worth, and only you know what that is until you share it with your insurance advisor, your perceived net worth, and your potential future net worth. So what is your perceived net worth? Now, all of us work in real estate, and when I used to work in my previous insurance career, I dealt a lot with farmers who owned land, and many of them have had their properties on the land that they owned and they farmed, etc. And it's a similar thing, because we're talking real estate, right? Any person or attorney who sees people that are working in real estate, who own houses, who are flipping properties, especially because of all the media coverage that says anybody that flips properties is making $40,000, $50,000, $60,000 in profit every single time, and so they're thinking that we have this huge perceived net worth, right? And so that's gonna encourage any attorney worth their salt to go for more money, whether you have it or not, whether you're extremely profitable or not, whether you're starting out or not. You know what I mean? That's your perceived net worth. The more exposure, social media exposure that you have, the more things you're involved in, it's going to increase your perceived net worth. And of course, your potential future net worth is, once your projects start happening, once you start investing in more properties, maybe you even have an inheritance or something that happens, which increases your net worth. You want to make sure that the amount of liability coverage that you take out is enough to cover all those things. And when you're talking about commercial or insurance, which is what we work in specifically, the cost to increase your liability on a commercial or business side versus the personal line side, the cost is so minimum to go from the lower insurance limits of $300,000 or $500,000 to go into the millions of dollars of insurance. Now, no one's saying to overinsure. Don't just go out and buy $5 million worth of insurance liability because it's affordable. If you really don't need that, then don't go all out. Increase as you need it, but make sure that you get as much as makes sense and that you can afford. So that in case anything happens, you're covered. And one thing that people don't often think about and realize is that when something happens, it's not necessarily whether you get a judgment rendered against you or whether you were really liable against those things. It's the defense costs, which can often kill you. Even if you're not found guilty or liable, or there is no judgment against you, those defense costs can add up tremendously, especially the longer the things drag out. Obviously, they can eat up into that liability coverage very, very fast, and that I think is something that a lot of people don't think about. They just think about, well, if I get sued and I lose, I need this much. Well, no. What if you win, but it took you a year and a half to fight it? Because everybody knows that lawsuits don't go quickly. Okay, there's some tremendous costs there. All right. Moving on, number 6. And if you guys have any questions or comments along the way, make sure you stop me. Feel free. A claim that occurred before I or my entity owned the property shouldn't affect my insurance rate. Well, yes and no. There's different factors that insurance companies look at when they're assessing your rate. If you personally have had claims in your past, in your claims history, then of course that's going to affect your rate. But if the particular property has had claims and the insurance companies have certain reports that they can run to check out claims history on a particular property, and for example, if the property is deemed to have a higher hazard or be in a higher hazard area where there's more thefts, there's vandalisms, it's subject to flooding. There are people, there's a lot of arson that happens. There's a lot of things that can happen that can affect the insurance rate on a specific property. If it's in a flood zone or a high hazard flood zone, for example, and there's been flood damage before, like all those different things are considered, are taken into consideration when the insurance company assesses the rate for a particular location. And this is interesting to note, especially because we write business in all 50 states. So the rates are going to vary from state to state, obviously, dramatically in some cases because of claims frequency and severity. Certain states, especially towards the East Coast, where there's significant weather claims, the rates are going to be higher for those types of perils as well, because that's just kind of the way it is. California is pretty high, but then you go to New York and places like that, and it's even higher. It's crazy. But by and large, the claims history does follow the insured, but from time to time, it can have an effect on the rate on the particular property as well. All right, myth number 7. All policies and coverages are created equal. Now, of course, we understand that this is not true, although a lot of people just go out there and get the first thing that either their insurance agent recommends or has, because they want to write the business instead of being the insurance advisor that can tell them, look, I don't know that this is the right thing or the best thing for you. This is the best thing that I can get for you, but maybe you can find something else that's better somewhere else. And that would be performing your fiduciary duty responsibly as an insurance advisor. And that's something that I did in the very beginning. Yes, I insured my own projects with a couple of different carriers, but when I had other people, and actually I had a client who was a developer that started flipping some houses for a private money lender that he had. He approached me and I told him that I didn't have what I felt was the right coverage at the time. So I actually referred him out to a guy out of Indiana who had a better policy than I did at the time. So there are different things to consider, and all these different coverage types and forms are available. We have them all available, and of course, the insurance industry, by and large, has them available. So some terms to consider are actual cash value, replacement cost, and insurance to value. So what does that mean? That's referring to how you are choosing to actually have your claims settled. And let's get into just real briefly into what actual cash value is. On a very simple basis, actual cash value means that the insurance company is going to pay the loss, whatever the loss is, minus your deductible, minus whatever depreciation has taken place. So let's just say, for example, we have a loss and the roof is destroyed. And when the roof was brand new, it was worth $25,000, but now it's 15 years old. So now they're valuing the roof at $10,000. Well, now they're gonna pay that claim or settle that claim for the $10,000 instead of the $25,000 it's going to take to actually replace it, minus pay your $3,000 deductible. And so now you're going to be stuck with $7,000 when you actually need $25,000 to repair or replace that roof. So that's, on a very basic term, what actual cash value means. In most cases, you do not want to insure for actual cash value. Of course, the rate is a little bit cheaper for actual cash value. And there's been one time when I've used it, and that was when I was essentially redoing the entire home. So everything was going to be brand new. The sticks, the roof, the floors, all the finishes, everything was brand new. So if a loss were to happen during construction, or even after the construction was done while it's being listed, well, guess what? They're not going to really be able to depreciate something that's a few weeks old. So it made sense in that particular instance. But by and large, you always want to go with replacement cost when you can, because that's what it makes sense most of the time. Replacement cost simply means that the insurance company will settle the actual loss based off of what the actual cost to replace that particular thing. So in the case of the roof, if it costs $25,000 to replace that roof, they're going to pay the $25,000 minus whatever your deductible is. Okay, so you're always going to be subject to your deductible. All right, and then insurance to value. Insurance to value is something that most personal lines insurers use or almost force their clients to use. So, for example, I have a homeowner's policy on my home. They say that in order for me to have full replacement costs and not be subject to co-insurance, which we'll get into here in a minute, I have to be insured 100% to value. And the insurance company does their valuation and it says, okay, this is what it's going to take to completely rebuild your property. Do all the debris removal, tear the thing down, whatever the damage was, or if it's a total loss, basically clean up the lot, start over. The countertops, the cabinets, the appliances, all those things are taken into consideration, which is why in most cases the insurance to value, or being insured 100% to value according to my homeowner's insurance carrier, in many cases is much higher than what it would actually cost to build this property new. So if I was doing a development project, like some of the ones that we've looked at, where we're actually scraping the property and building one brand new, it actually costs more to. It actually costs, or I have to insure for a higher amount to be 100% insured to value according to the insurance company. All right, makes sense. And then of course you have your loss settlement provisions, either broad or basic, broad, or special. And without getting into real particulars about that, it's pretty simple to understand that basic is going to be the most basic form of coverage. Okay, broad is a little bit better, and special is the most broad form of coverage. Really, nobody ever goes with basic, and you certainly shouldn't. Sometimes people insure on their properties on a broad form, and what that means is basically known as a named peril policy. So you're going to have a specific list of coverages, and you're going to have a specific list of exclusions. When a loss happens, the adjuster is going to come and make sure that it's either on that it is on the list of coverages and that it is not on the list of exclusions. When you bump it up to special form coverage, now you're taking it from a named peril policy essentially to an all perils policy, which you still have your exclusions, the same exclusions as you have in a broad form policy, but now you don't have to have the coverages actually specifically itemized, which makes it way more open for interpretation. It opens it up much wider for more things to be potentially covered, rather than them having to be on a specific list. Of course, all the basic stuff is covered. You know, your wind and hail and water damage and fire and all those kinds of things are covered. But things like vandalism, theft, backup of sewer, all those different things can also be brought into under that special form coverage. Okay. Now, co-insurance. So co-insurance, just to keep it simple, basically means that you're going into a contract with your insurance company or the insurer, and you're going to be co-insuring that particular property or project. And when you're subject to a co-insurance loss or a co-insurance penalty, what some people are familiar with, if we use the example of my homeowner's insurance policy, if the insurance company says that I need to insure my property for $500,000 because that would be me being 100% insured to value, and I have to insure 100% to value, as most insurance companies are out there, in order for me to not be subject to co-insurance, meaning that I'm not going to be subjecting myself to going under an agreement that I'm going to be self-insuring part of those losses above and beyond my deductible. So what does that mean? How about an example? Let's just say that I decide, well, you know what? You're saying that I need to insure for $500,000. Well, I don't want to insure for $500,000 and pay that additional premium for that extra coverage. I only want to insure my property for $300,000. So now what I'm basically saying is that I'm only insured 60% to value, according to the insurance company. So if a loss happens, let's just say a loss occurs and the damages were $100,000. The company's going to come in here and they're going to enforce that quote unquote co-insurance penalty. And now what are they going to do? They're going to settle that claim with that 60% co-insurance penalty, meaning that they're only going to pay $60,000 on that $100,000 loss. So really the penalty is 40%, right? Because I'm 40% underinsured. And so because of that and the way their contracts are written, I basically am agreeing to that co-insurance clause, that co-insurance penalty, when I insure my property for less than what they say I need to. And of course, we don't like that as real estate investors, and there's reasons that when we created all of our programs for real estate investors, by real estate investors, we address all those things so that we're not subject to those things. And we'll talk about that. Number 8, self-insurance is too risky, right? So what are we talking about self-insurance or self-insuring? Self-insuring is actually a very good loss prevention tool because your premium, believe it or not, is a loss. So even though you may not ever incur an actual loss or a claim, the premiums that we're paying every single month, every single year on our properties, on our projects, on everything else, that is a loss to me. That is a loss to my business. So one of the ways that I mitigate that loss is by self-insuring a larger portion of my exposure or of my property, whatever that exposure might be. And one of the simplest ways to do that is, of course, to carry a higher deductible. Anybody that tells you should carry a $500 or $1,000 deductible, I think is steering you wrong, because you're paying more premium for coverage or to carry a lower deductible when most people are not going to file claims for those smaller items, because it's way too cumbersome. It affects your insurance rates. It does all these different things, right? So the higher the deductible that you carry, or you self-insure a certain portion of that, is going to lower your premiums. So it's going to lower and help you mitigate your losses in insurance premiums that you're paying every year. And as you're growing and you're insuring more and more properties and more locations, let's just say now you're building a portfolio of rentals as well as doing your fix and flips, those insurance costs spread out over all those different locations and over all those different exposures can add up. And that is a loss that you're taking. So that is one way that you self-insure. Another way that you self-insure, which is a very smart way to do it, by the way, is of course, to not say that you're going to insure your properties for what a normal or conventional insurance company would say is 100% to value, because maybe your cost basis is lower. Maybe you can rebuild it for cheaper. Maybe you're only you only owe or have a certain note on the property that's below what the property is worth. And so again, you want to cut that loss in premium by insuring that property for less. And when you insure it the right way, you're not subject to co-insurance. You're not subject to any of those other penalties that we're talking about. And I can show you guys how to do that. Okay, so self-insuring is a very powerful loss prevention tool. All right, number 9, I need a quote unquote builder's risk coverage for a vacant or rehab project, deal, or property. Now, builder's risk policy is a very commonly used form, or something that a lot of people say, hey, you should go get a builder's risk, not necessarily understanding what that is and what that means. We certainly write builder's risk forms, and there are a lot of companies out there that write a builder's risk form, but that might not be the best form for your particular situation. We do write commercial policy forms, which allows us to tailor a lot of coverages and not just be kind of an off-the-shelf insurance coverage provider. So depending on your particular situation, depending on the state, depending on what you're doing, we can talk about those things. But the builder's risk policy is not a carte blanche. Hey, yeah, I got the right type of coverage, because depending on the carrier, the builder's risk policy might also be different and have different limitations. So we take that on a case-by-case basis. All right, number 10. It is worth it to hire the handyman to do the work on my rentals or on my properties. And I wish my partner Scott Travis was with us right now, because he would basically be falling out of his chair right now, because there's a lot of people out there not only doing this, but teaching other people to do it. There are some, I wouldn't necessarily say gurus, even though the gurus do recommend it and do it as well. I've heard them say it many times, but there are other smaller people out there that are helping to educate people, that hold educational events and seminars and different things, that advocate the use of handymen to save on costs, right? And believe me when I tell you that it is not worth it. You want to use somebody who's experienced, who's licensed, who's insured, and in most cases, who's bonded. And yes, because of all those things, because they're doing things the right way, they're going to cost you a little bit more. But when something happens, you have the security of knowing that these guys are not going to go anywhere. These guys are not going to, or their workers, for example, are not going to sue you directly because they got hurt on the job, or they're not going to sue you directly because they got hurt on the job. And so a handyman you hire comes on your property, you're hiring them, they become your employee, and you're now subject to workers' comp laws and taxes. So if something happens and he hurts himself, or he's just one of those guys that is going to run a racket on you, you're opening yourself up. And again, that's why it's being penny wise and pound foolish. You're not gonna be experience much longevity in this business by using this thinking this way and using this mindset. To that, and off subject altogether, please do not buy materials for your contractors yourselves, okay? Because again, now you're opening yourself up once more to that employee-employer relationship, making you subject to workers' comp laws and taxes. So don't do it. Unless I wouldn't recommend you being the handyman on there either. But if anybody's going to do something themselves on your projects, it should be you. Everybody else needs to be licensed and insured. All right, number 11. If I use my personal vehicle to service my properties, my personal auto policy is sufficient. So this again is another myth, and just like anything else in insurance, everything is fine as long as nobody ever finds out, right? As long as nothing ever happens, and no one ever knows, and you never need the insurance, do whatever you want, right? But that's not why we pay our premiums for insurance. That's not why we'll pay more in some cases to have the right type of coverage or adequate limits of insurance. That's not why we go through the aggravation of reviewing our policies and doing all that kind of stuff. The reason we do that, and the reason that we pay our premiums, the reason that we carry it, is so for the off chance that when it does happen, because we all know it does, you have the right insurance. You're not thinking about how much you paid for premium. You're not thinking about, whether or not you got away with something when a loss happens. All you care about is the insurance company going to pay. And what ends up happening here is you have an auto accident, something happens, and you're in the course of work or in the course of your business, doing something for your business. You're essentially, think about it, if you work for a corporation or a company, and you use your personal vehicle to run a business related errand, or you're driving it while you're on the clock, even something as simple as going to get lunch for your coworkers or for your boss or for your employees, for example, and something happens during that time, that is a business related claim and exposure. And so your personal auto policy and the claims adjuster, when they go to review all the details, they can just deny your claim because it is a business exposure, not a personal exposure. Okay, your personal exposure is you drive your car to and from a location. That's it. That's not business use. But if you have rental properties and you're going around checking on them, or you have rehab projects, or you're going because they're close to you, and you're going to the location and you're working on it and you're running errands, and okay, now you got to go pick up this thing from Sherwin-Williams, or you got to go meet the contractor at Lowe's or Home Depot. Those are all types of exposures related to your business. So again, if that's something that you're doing regularly, and I mean that's what you do, it's very advisable to consider just pulling maybe that one vehicle into a business policy. Number 12, it's enough to simply require renter's insurance in my lease. So where this comes from is there are people out there, believe it or not, that they have rental properties. Okay, and I know a lot of this is kind of geared towards landlords or people getting into that business, because ultimately all of us want to have cash flow. Okay, we can't flip for the rest of our lives. That's not where the security is. It's all cash flow. So and we insure over 40,000 rental properties nationwide, and so it's really one of our high levels of expertise in these types of coverages. But there are people out there who think, okay, now I'm gonna require my tenant to carry renter's insurance. Now, is that a good idea? Is that a great idea? Yes, absolutely. If you can require it, I would recommend that you do so. There's various reasons why. One of the reasons is when they bring the exposure there. Say they have friends over, family over, they have a party, they have a barbecue, whatever happens, anything that they bring onto that property is liability that they're bringing onto your premises. Okay, you're still the titled owner, and liability always rests with the titled owner. One of the functions, as far as how it benefits you to have your tenants carry renter's insurance, is that now if a loss does happen, the renter's policy acts as the first line of defense. So let's just say they have a renter's insurance policy. You make them carry the max of $500,000 in liability, depending on the state that you're in, and something happens, their policy is going to act first. And of course, that prevents you from having to go through a claims process. It prevents you from having a liability claim on your clue report and your insurance, etc. So it can help keep your rates lower over the long term, and all those good benefits. But of course, the tenant has their benefits as well, because again, it is their personal liability that they're protecting, and that follows them anywhere they go in the world. It covers libel, it covers slander, it covers you know bodily injury, covers personal injury, covers all those different things that they would not have coverage for otherwise. So it's really to their benefit. And of course, it covers their personal property, which you don't care anything about, but it's, they should care about it. And so, it needs to be presented to them in a way that they see the benefit. A lot of tenants don't want to carry it because it's an additional expense. Well, I mean, come on, again, being penny wise and pound foolish, and they should cover that kind of insurance. But getting to the point here, the mistake that a lot of landlords make is thinking that that's going to be sufficient to cover the remainder of their exposures. Now, it's not. Because one, if the liability coverage is insufficient, say there is a claim, something happens, somebody dies, somebody gets really hurt, and whatever limit of insurance that they're carrying is not sufficient to cover that claim or that loss, now your policy, which would be your dwelling policy or your tenant occupied dwelling policy, would cover the additional liability required to protect you. Plus, if there was any kind of damage to the home itself, if there's a fire or damage of any kind, now you also have insurance on your property, because the tenant's insurance will not cover property damage to your property. So you gotta still have your adequate dwelling insurance policy on your rentals, and not rely or depend on your renter's insurance. Got it? Okay. Myth number 13, cheaper is better. We talked about that at the very beginning, right? Now, the policy that my first joint venture partner had was super cheap. It was like $600 for the whole year. And it only took us about 4.5 months to flip that property. So really, we only paid like $400, or less for that insurance. So yeah, sure, it would have been super cheap, right? But when a claim does happen, it's not worth the paper it's written on. We might as well have just burnt that $600 some that they quoted us and that she had put in force. So quality is or value is what you're after. Okay, not necessarily cheaper or more expensive. Okay, the first thing you have to focus on is the right coverage, because I guarantee you, again, when a loss does happen, the last thing you're going to think about is how much you paid for that insurance premium. So first and foremost, the right coverage, the right features, the right conveniences have to be first. Now, the benefit and the bonus is that the premium is also competitive. Maybe not necessarily the cheapest, but comparatively speaking, the most the biggest value, right? Because once you start comparing, you say, okay, well, maybe these premiums are the same, but I'm getting this much more, or maybe this premium is 5% more, but this is why I'm getting this much more, and it's worth it to me because these things are important, like theft coverage, for example, like pollution coverage, for example. All these different things that we can go into, that no co-insurance penalties, no minimum earned premiums or minimum earned premiums, all these different things that make a difference. So can a policy sometimes be the most competitive and be the best one? Yes, absolutely. Depending on the situation, the state, see it happen all the time. In some cases, when you're comparing something like what I described in the beginning against the right type of policy, are those premiums going to be comparable? Absolutely not. Of course, you're going to pay more for the right coverage versus something that is absolutely useless. All right, so those are the 13 myths, and we managed to get it in just under an hour. Let me go over a little bit of why we're different. Okay. And some of the benefits that we offer to all of our real estate investors, regardless of the strategy or type of projects that you're involved in. We tailor all the coverage and benefit packages specific to your business model. There are no minimum earned premiums, so you only pay for what you need on a month-to-month basis. A perfect example of this is I reached out to a hard money lender that I know. He was referring me some business. It actually happened to be his son that he was lending the money to through his company to do his flip. And I was reviewing the coverage, and we found all these reasons why we need to switch coverage. And one of the things that was on there is that it had a 50% minimum earned premium on this 6-month policy. So the unfortunate thing is that, and the premium was pretty high too, but the unfortunate thing is that he had already paid the premium. Coverage was already in force for several days, and they were unwilling to flat cancel that policy. So we're not going to write the insurance on that particular project. We're going to write it on the next project, because he would have had to basically walk away from about $1,900 in insurance premium because of that minimum earned premium. And in most cases, it's 25%, but it can go as high as 50% minimum earned premiums once those policies get going. We don't have that. It's from basically prorated from day one. Whatever you use is what you pay for. So if if you finish the project in 3 months instead of 6 months, well, guess what? You're only going to pay for those 3 months, regardless of unlike some other carriers that would have that big co-insurance penalty, and it doesn't matter if you finish early. Of course, all of our company principals are also real estate investors and private lenders. That's one reason why they're able to tailor all these things, because they understand it. They've been through it. They want to know the ease of use. They want to know that the right coverages that come up in the claims that they experience and that they see are being offered by the way that the packages are structured. We also own our own captive insurance company, which allows us to be very, very flexible and basically tailor the coverages that we want to, and then get the reinsurance for them. As far as the co-insurance penalty goes, as long as you're insuring your properties for $45 a square foot or higher, co-insurance does not apply. So all of our policies and coverages are written on what's called an agreed value basis. So it basically means that, let's just say, typical insurance company says that the insurance to value is $500,000, like we said before, but you want to insure it for $300,000, and we agree that $300,000 is the right insurance coverage for whatever reasons that makes sense. If a loss happens, we will pay up to that $300,000. And we will also do it with a cash out provision with no penalties. So if for whatever reason you just want to walk away from that location or that property, and in some cases it definitely makes sense, and I've known many people who have done that, both in my previous insurance career and this one. The difference is that when you evoke a cash out provision on a conventional type policy, you usually penalize pretty severely, like 30, 40, 50%. So, okay, I want to cash out of this, and all right, well, here's 150,000 instead of the 300 that we'll pay you to rebuild, because that's ultimately what most insurance companies want you to do. They want you to repair or rebuild. We'll cash you out for the agreed value basis as well, or pay you the full value, as long as you're insuring a minimum of $45 a square foot. Once you get over $65 a square foot, as far as your insurance to value, you garner full replacement cost coverage as well. And of course, going to 75 a square foot is probably the minimum that I would recommend. But this allows you a lot more flexibility to do what you would like to do there. We offer liability only as well, if desired, depending on locations. And that makes sense if you have, if you're investing in a node of pools, or if you've bought a package of properties. Say you bought 4 or 5 properties because you bought them as a package, and you're not necessarily sure if what you're going to do with 1 or 2 of them because of the locations. In some cases, when you buy a package of properties, whether it's 5 or 50, not only does it take you a while sometimes to figure out what you want to do, but in some cases, you're getting a little bit of garbage. And so it might not make sense to do anything. However, you still own those properties. And because you are the title insured, you have liability of that property. So even if it's in a bad area and you have people, kids getting in there and fooling around or squatters, or something happens and somebody, God forbid, gets hurt or dies, and a family member looks up who the owner is because it's time to sue, they got hurt at your property, you got to make sure that you're at least protected for liability, even if you don't care about the structure itself. All right. Occupied, vacant, or renovated, or properties under renovation can be included on the same schedule. Okay. One thing again is ease of use, especially for the sake of scalability, because no real estate investor wants to stay with one property or one rehab at a time. So what happens in most cases? Okay, well, I got a property. I need a new policy. Here's a new down payment, and let's go. Okay, I got another property. Okay, let's start a new policy. Here's a new down payment. Here's a new process. Let's go. Okay, I finished this one. Let's go through this cancellation process. Send me all this stuff. Well, under our program, you can add and remove properties on the fly. So, hey, I just bought this property. This is how I want it insured. There's no new down payment. So it lets you keep more of your actual working capital. If you finish a property or sell it, you can just call or send an email and say, hey, delete this property as of this date. We no longer have it. If you are renovating a property for the sake of keeping it as a rental, for example, we can change the type of coverage on the fly as well. Whereas in any other system, you would have to cancel and start a new type of policy with the right type of coverage. So say you start off with a vacant property. Now all of a sudden you're under renovation. Okay, we change the coverage type to renovation. Now you finish it and you get a tenant in there. Now we change the coverage again to the right type of tenant occupied policy. All on the fly without making you cancel and start coverage over again, do new down payments and all that kind of stuff over and over again. You can do that also if you're investing in notes, because sometimes you're going to work the note out. Sometimes you're going to foreclose and turn it into a rental. Sometimes you're going to have to make some renovations on the property. So all those different things can all be done on the fly and all on the same monthly reporting schedule, broken out per property, per location, per month, per all the different costs, so you understand what's going on. Coverage is also available in all 50 states. So it doesn't matter where you're investing, whether you're doing flips or rentals. It's all about ease of use and maintaining that relationship. And one thing, especially since I was in the insurance business and I am in the insurance business, when I had to deal with a bunch of different carriers, for example, even for my own insureds, and I get to establishing relationships with my underwriters, etc. And then all of a sudden the underwriter moves or I have to go somewhere else. It's just such a pain having to keep everything straight. So for the sake of our insureds, and one thing that I love about it is that I have one reference point. All my billing comes from the same place. I pay it all at the same time. If I have any questions, it's always the same people. And it doesn't matter if I have my projects in Indiana or Atlanta or California, wherever it is that I want to go, it's all done with a central location by the same team of individuals with stable rates across the whole platform. So it's super, super easy. And I mean, and the reason that I'm so passionate about it is because I was just a client first. And I was just like, yes, when I met the owner of the company, I didn't know he was the owner of the company, and we started talking insurance, and I was basically selling him his own product and telling him that he had to do pretty darn good to beat what I had found. And it was actually pretty funny. Then I found out that he's like, well, are you sure you're not insured with me already? And it turned out I was. So here we are a couple of years later, and I'm proud to advocate for them because I know what a great benefit it is to my fellow real estate investors. Another thing that we do is we handle our claims through McLaren's International, which they're basically a third-party claims administrator. So the claims get handled very quickly and in an unbiased way. Our coverage is available for everything that real estate investors use and need, right? LLCs, trusts, corporations, etc. Whereas many carriers out there kind of scoff and shy away from, multiple ownership interests and entities, and not only that you have it insured under the right type of entity, but in many cases when you're joint venturing with people, now you have multiple entities on one deal or one project. And so that really becomes hairy for most insurance companies out there. Well, of course, we're real estate investors, so we understand that, and we don't have any problem with that. All of our coverages are underwritten by an AM Best A-rated carrier or better. And so when people say, "Well, who do you use? What carrier do you use?" and whatever, it's always, it depends, because again, we write coverage in all 50 states, but not every insurer goes and writes coverage in all 50 states. So we use our leverage and the leeway that we have, being licensed in all 50 states, to place coverage with the right insurer for that particular state. But we never use anybody that is less than an AM Best A-rated carrier or better. Another very important thing here is that theft coverage is available on vacant locations and projects under renovation, which is typically completely excluded. And again, just like I think most people overlook the importance of liability coverage over property coverage, most people don't understand the need and the importance of theft coverage, especially under a vacant or renovation type project, because even though, yes, the peril of fire is very viable and can be significant, what's more likely to happen is for you to have a theft or a vandalism in that particular property. And you're in the business long enough, you do enough projects, even rentals, you'll know that to be true. And I've had AC units stolen. I've had every type of appliance stolen or attempted to be stolen. Had one particular project where they messed up the floors, dragging the stuff out. They got the refrigerator out the door and in the truck until a neighbor spooked them. And when we went in there, the stove was in the middle of the living room. The dishwasher was behind it, and the water heater that had the lines cut from it was in the kitchen on its way out as well. So that is way more. Theft is probably more likely to happen than a fire, or than in certain states, a windstorm or something like that, to do damage to your property. And most policies exclude it or have a significant limitation, where our policy forms include it. I know I spent a lot of time on that one. It's because that one kind of burns, right? Because I've experienced it multiple times. Now, this is something specific for our private lender clients, which is critical for them. We will not allow any location coverage to cancel without their acknowledgement. So if you're considering being a private lender and you're going to deal with borrowers, obviously the insurance is going to be one of the number one things you want to see in conjunction with the closing of your loan. But what happens sometimes is the rehabbers get in trouble, and the expenses get tight. And one of the things that goes sometimes is the insurance premium. And what happens when the premiums start being paid? Well, the insurance companies cancel the coverage. And certainly they issue a notice that it's going to cancel, giving you kind of an opportunity to do something about it. But ultimately, if the premium isn't paid, the policy cancels and coverage is gone, which is bad for everybody. And from a private lender's perspective, that's all they care about, because that's properties collateralizing their loan. So we will actually carry the insurance on that location, and not let the policy cancel without our private lender's acknowledgement. And I think that's pretty darn cool. For our property management clients, we obviously can aggregate all locations under management on one policy, which allows us to provide additional pricing benefits, which then, of course, they can translate over to their clients. And one thing that's pretty cool is that we also offer coverage for non-U.S. citizens. Now, why is that important? And why is that something for all of us to be proud of? Is because there is a lot of private money outside of the United States. Okay, so we're not getting into issues of illegal immigration and all that kind of stuff. The point of the matter is that there's a lot of money outside the United States that wants to invest in the United States, and that does great wonders for our economy and our systems here. And so by allowing those non-U.S. citizens that are outside of the country to bring all their money here that they want and provide the right type of insurance for them is critical. All right. The last thing here, which I've already kind of stated, it just emphasizes how, again, this whole thing was created by real estate investors for real estate investors. Obviously, the principals had an extensive insurance background when they got into this. Now the program insures over 40,000 locations nationwide. We have over 6,000 individual investors that we insure, and we have a team of nearly 40 dedicated people, all licensed in our main office, that handles all the insurance needs. So we're very much on top of it, and are eager to help with all the insurance needs for the real estate investors. So for more information or questions, anything like that, feel free to email me at ivan@nreinsurance.com. Reach out to me on Facebook for those of you who are with me on Facebook. If we're not connected on Facebook, go to c2crea.com/connect, and you'll find all my personal information there as well. And if you need any kind of help with your rehab projects, if you're just getting started, if you're not sure how to do it, if you need to rehab remotely and you need our consulting services, we also offer that. And my partner Scott Travis also heads that particular service with his 20 plus years experience as a contractor. So now, thank you all again for sticking with me all this time. And I'd love to open it up for questions or comments if you guys have any. I know insurance isn't the most critical or exciting topic, but it's something that we definitely need to understand. And hopefully I can keep you guys entertained enough and engaged to not fall asleep. Let's see here. Give us an example of how a policy on a property and rehab is structured. What types of coverage, how values are determined, where we might insure versus load up on self-insure, load up coverage, etc. Okay, so hang on a second. A basic, to give you guys a kind of a basic example, and so we don't make this too long, I can even give you an example of my a particular certificate of insurance that I have, so you can see what is being offered. So follow up with me afterwards. I don't have it pulled up, and I don't want to be going through my computer to pull it up right now. But the way that I insure my properties is on a commercial policy form, so that I have the pollution endorsements. I do it on a special form contract, do replacement cost, and depending on the location, how I assess the value is going to be somewhere in between what the property is going to be worth and what it's costing me to actually rehab. So that's kind of how I'm self-insuring, right? Because I'm not going for the full retail value, because I know that's not what, if the thing burns down, I know that's not what it's going to cost me to actually rebuild the property, because I already know what my cost is to build the property or to rehab the property. So I go somewhere in between, and in most cases, like I said, it's definitely above the $65 a square foot. So I'm garnering the replacement cost coverage, and let's see here. $1 million in liability, have the full theft coverage on there as well, and it's all structured on both a liability form and a property form, with my private lenders listed as mortgagees. So it's really quite basic and simple when you break it down. But I can show you what that on a different webinar, or even offline, I can show you what that certificate of insurance would look like, so you know exactly what the coverages, how they're broken down. And ultimately, the best thing to do, guys, is going to be to once you have something under contract, or you want to look at something, we'll go over your individual property or project and go through the different options, so that you know how to make the right decision. All right. So Michael took lots of notes. Awesome. And Fred, thank you for the question. All right. Anything else? Any comments? Well, if there's nothing else, remember, you can contact me at ivan@nreinsurance.com. I hope that your real estate investing businesses start to take off and go in the right direction. Yes, you're still awake. And thanks for the comment. Great follow up to last week's presentation. Thank you so much, Arthur. I appreciate that. Let's dispel the myths out there and make sure that we all have the right coverage at the right time for the right purpose. Until next time, guys, make sure you're allergic to average. Wake up every single day and live off your list, like we like to say, and make a plan and work your plan. And I need to say that for you guys just as much as I do for myself, because it gets tough sometimes to really stay focused and understand what you're doing in a particular day. And before you know, the day is over. You were so busy, but what exactly did you get done? And if you don't have a way to measure that, then we need to sit down and talk about it so that we understand which direction we're going and how to best capitalize on our efforts every single day. So thanks so much, guys. Have a great evening, and we'll catch you guys next week. And please, I never asked this, but if you guys actually enjoy the content, are learning something, find some value, just share it publicly. Talk about it. Don't keep the value to yourselves. Spread the value to others, and definitely share the webinars and the different podcasts and different things that you find value in. So until then, have a great night, guys. Thanks so much. God bless you guys too. Bye-bye.